Okay, let's talk about the subsequent valuation of accounts receivable, that is, accounting for ultimate credit losses or what we call bad debts. Recall that the seller accrues revenue and the associated account receivable when it has completed its performance obligation and earned the right to receive payment. We learned that in our revenue recognition studies. Payment is not assured, though, when we grant credit. Credit losses are an inherent risk associated with granting credit. Accounts receivable is reported on the balance sheet as the amount of cash that is ultimately expected to be collected. That is the accounts receivable total less the allowance for doubtful accounts. And so let's look at the accounting for credit losses. And again, the accounting theory here, the accounting rule is bad debt expense is recognized in the period of the related sale, not when it turns out to be that we learn it's uncollectible. All right. So Porter Consulting started operations in the year 2024. In that year, the company reported revenues of $800,000 and then collected cash on those revenues totaling $600,000. So at the end of the year, an accounts receivable balance of $2,000 was in place, remained. So we need to account for what percentage of those amounts that haven't been received yet to date will actually not be received. Porter's chief financial officer is a veteran of the industry. She expects to collect 90% of the $200,000 still owed to the company. So the requirement is prepare the adjusting journal entry to record estimated bad debts. So let's see that. Indeed, why don't you go ahead and pause the video and record that entry. All right, welcome back. So recall that the chief financial officer believes that $20,000 will ultimately, of that $200,000 balance, will turn out to not be received, be uncollectible. And so to that, that is the amount. Again, 200,000 remaining accounts receivable multiplied by 10%, because the CFO estimates that 90% will be received. And so what types of accounts are these? The bad debt expense is the expense account, and this effectively matches the ultimately the sales that for which cash will not be received against the sales in the period they occurred. And then we don't overstate sales. And then we also set up a contra asset, the allowance for doubtful accounts. So the net accounts receivable is always the total accounts receivable less the balance in the allowance for doubtful accounts. All right. And you saw below that the other requirement in this case was that on January 8, 2025, we have evidence that we're learning which is one of the customers that will ultimately prove not collectible. It's Tanning Beds Unlimited, and they owe a $2,000 bill, but they declared bankruptcy, and which deemed that this will not be received. Now, keep in mind, it is still legally owed to the company. If we can get anything out of bankruptcy or at all, or they do a what we call a reorganization bankruptcy and get back to profitability, then they still owe us this amount. But for now, we're assuming it will not be collected based on that evidence that they declared bankruptcy. And so now we have learned one of the particular accounts that's going to prove uncollectible. So this no longer has to be a contra accounts receivable, because now we can actually write off the account itself. So we zero out the contra accounts receivable and we reduce the accounts receivable associated with this particular customer. Tanning Beds Unlimited. All right. And that's the accounting for accounts receivable. Now, I added a little note here for your information. If it turned out that the company did receive a portion or all of the previously written off account, what we do is we simply reinstate the accounts receivable by reversing that, and then debit cash and credit accounts receivable for the amount we actually did receive. And then we no longer have that legal claim to the 2,000. And so we zero out the account receivable. And that's the accounting for accounts receivable. Now, let's take a closer look at estimating that amount. In the previous case, with Porter Consulting, we did that 10% will ultimately prove uncollectible. In the real world, they use a little more sophistication usually. Here's the rules. We use the current expected credit loss model, which you'll hear called CECL when you're at your companies and in the real world and at your CPA firms. The CECL method, the current expected credit loss method, says that we apply any method that reasonably captures the expectation of credit losses that will occur. So in the Porter Consulting case, it was 10% of the remaining balance. The carrying value of the net accounts receivable is the amount of expected future cash collections. That's what it is. So it's accounts receivable minus that allowance. And we estimated considering all receivables. The estimate is determined based on any relevant information, including historical experience, current economic conditions in the industry, and reasonable forecasts. Potential methods include analyzing each customer account, if that's a realistic possibility. With most companies, it's not, because there's just too many of them. Apply a percentage to the entire accounts receivable balance. That's what we did in the Porter Consulting case. Or apply a percentage of bad debts to accounts receivable balances depending on the length of the outstanding receivable, of the time that receivable was outstanding, has been outstanding. That's called an accounts receivable aging schedule. Let's look at an example of that. Right, and here it is. The Creve Coeur Company offers 30 days of credit to its customers. At the end of the year, bad debts expense is estimated and the allowance for uncollectible accounts is adjusted based on an aging of accounts receivable. You'll see an aging schedule in a moment. The following balances were in the accounts receivable related accounts as of the end of last year. So this is also the beginning of the current year, 2025. Right? During 2025, sales on credit totaled $2.5 million. Cash collections from customers were $2.25 million. And actual write-offs of identified accounts receivable were $45,000. Okay? That's 25. And if you look at that, let's summarize that a little bit. And I'll also talk more about the aging schedule. This is the accounts receivable aging. The aging schedule is what you'll hear it called often in the real world at your firms and your companies. Okay, so let's summarize what we just learned. So here is the 1/1/25 balance in accounts receivable, $500,000. I got that from last year's balance sheet, right there. there is the beginning balance in the allowance account. Again, I got that from last year's balance sheet, and as given here with this little excerpt from the balance sheet. And so net is $450,000 net accounts receivable at the beginning of the year. During 2025, we had sales of $2.5 million, and so we debited accounts receivable, and that's right there. And we credited sales revenue, which is in another account not shown here. We did have a allowance for doubtful account that were actually determined uncollectible. And so in that case, we made that entry I described above, and there's the debit to the allowance, and there's the credit to the particular receivable. And so at the end of the year, we have $705,000 of total accounts receivable, less $5,000, or $700,000 net before we do our journal entry. That, of course, is going to turn out to be way too low. So before AJE for uncollectible accounts. All right, that's where we're at so far. And keep in mind, by the way, one thing I didn't mention is this. That's the cash and accounts receivable during the year. Cash collections from customers were $2,250,000 during 2025. So that's the sum of all of those credits to accounts receivable when we debited cash. Okay, so that's where all this is coming from. It's simply the posting of all of the entries to the accounts receivable and the allowance for doubtful accounts during the year. Now we have to do the adjusting journal entry because this probably is not high enough. So we use that aging schedule you saw on the last page in the facts. And we learned that the estimate of if the receivable is 0 to 60 days old, by history suggests about 5% of those will prove uncollectible. If it's 61 to 90, maybe there's a problem. 10% of those will ultimately prove uncollectible. If it's been out over 3 months, but 3 to 4 months, 25% of those will prove uncollectible. And if it's greater than 4 months, it's about a half chance we'll never get the cash. So we use these percentages, with a little times mark there, to get our estimate of uncollectible from each time aging pool. 27,500 of the 550,000 that have only been out, receivables only outstanding for 1 or 2 months, 27,500 of those will prove uncollectible. 10,000 of the 2 to 3 month old will prove uncollectible. 10,000 of the 40,000 in the over 3 months but less than 4 months, and then 7,500 of the 15,000 in the over 4 month aging category. So we want that balance to be 55,000, and we'll do so by debiting bad debt expense for the year of 50,000 and crediting the allowance for an additional 50,000. And that's how you do the more sophisticated method of applying different percentages of bad debts to accounts receivable balances depending on the length of time outstanding. The accounts receivable aging schedule, which was the third of the potential methods we discussed during our discussion of the current expected credit loss model known as the CECL model. Okay, and so at the end of December 31, 2025, this is what you're going to see on the balance sheet. You're going to see the amount actually owed to us of $705,000, but then you're going to see the allowance for doubtful accounts of $55,000. So accounts receivable net is $650,000. And that's accounting for accounts receivable and then estimating bad debts, both in a rather easier method, percentage of total, as we did in the Porter Consulting case, or in this case, using the aging schedule. That is what you'll see more frequently at your companies and your firms. All right, thank you for your attention. Have a great day.